Hello and welcome to CKPG TV. Today we bring you a special broadcast that focuses all about the real estate market and how it fared during the COVID-19 pandemic. So let's get right into it. We start real estate in Prince George, affordability in an overpriced market, with a look into maybe one of the most discussed topics in recent years, interest rates. From their sudden drop to their gradual incline, Jack Clark tells us more about the changes interest rates went through during the pandemic.
The story of real estate over the course of the pandemic cannot be told without the term interest rates. One I think we can all agree has become far too common over the last year or so, and it's all because of inflation.
When you have high inflation, the government of Canada, our fiscal policy, even our monetary policy when it comes to how we print money, is driven by a desire to keep inflation at about 2%. And that's a sensible policy to have. The Bank of Canada, when it sees inflation going very high, will raise interest rates to slow things down.
Since February of 2022, the Consumer Price Index has risen 5.2% and even higher than that depending on the month. And because of that, interest rates rose almost consistently over the course of the last year to try and counter that, which makes the cost of borrowing money that much more. But this trend of up and down interest rates isn't unique to just the COVID-19 pandemic.
Look at the 1990s and earlier, and before that, the interest rate stayed anywhere between 6 and 9% over the years for a 5-year rate. And then all of a sudden, when 9/11 hit, overnight the interest rates dropped worldwide by 2%. And they would have difficulty with the financial system. Then the banks have to raise interest rates in order to be able to satisfy the depositors.
But just because the idea of rates rising after a severe drop isn't new, it doesn't mean people who took advantage of low fixed rates during the pandemic aren't being impacted now.
Unfortunately, what is that the property values didn't go up, just interest rates caused the people to come in with more money. We realized that the people who bought through 2001 and 2000, or 2021 and 2022, they've got some big mortgages, and whether or not they've got enough equity in there to get out of them or not is going to be different if they want to sell.
As of the latest Bank of Canada overnight decision, interest rates held for the second straight time at 4.5%, which hopefully shows signs of a return of a normal real estate market in the near future.
Most analysts are kind of expecting that rates are going to come down. That's what BCREA is expecting. Rates are going to come down over the second half of this year. Inflation is going to continue coming down. And we're going to kind of do we're going to come in, we're going to land smoothly.
The Bank of Canada has 6 more dates for interest rate decisions over the course of 2023, with the next coming on Wednesday, April 12th. Jack Clark, CKPG News.
After looking in detail about the specifics of interest rates, we now take a look at the impacts of interest rates on buyers, renters, homeowners, and overall consumers. The last few years have been hard, particularly the last 2 years where interest rates were hiked on a regular basis by the Bank of Canada. With current rates, those looking to buy a home right now may be having some second thoughts. Inflation. It has hit hard this past year with costs rising on everything from food to gasoline. While lower interest rates are more appealing for those looking to borrow, it does not help with inflation. With higher interest and inflation, those looking to borrow to buy a house potentially may be a bit more hesitant now.
The big issue has been inflation. When you have high inflation, the government of Canada, our fiscal policy, even our monetary policy when it comes to how we print money, is driven by a desire to keep inflation at about 2%. And that's a sensible policy to have. The Bank of Canada, when it sees inflation going very high, will raise interest rates to slow things down. Now, it's important, they don't necessarily want to slow economic growth. They want to slow down the price of things. So they want you to buy more refrigerators. They just want the refrigerators to be cheaper.
Bob Quinlan says that the banks are being careful when it comes to borrowing.
The banks were being very careful because they with their history, they understand that what's going to happen is this is going to level off, which it did. So what they were looking at with borrowers is they're making sure that their income was tight, that their down payment was good. They may even ask for, instead of 5% down, they may ask for 10% down or 15% down to give them that cushion. And they won't give them a lot of other things that they can qualify for income so that they think they can make more payments.
Housing nationwide is cheaper than a year ago.
Housing today across Canada is 13% cheaper than it was a year ago. Fuel, although it doesn't feel like it when we're filling up our gas tank, is actually a little bit cheaper than it was a year ago. Food is the area that we're most concerned about, because we're still seeing 10, 11, 12% increase in inflation on foodstuffs, which we suspect will likely improve when we see borders open up a bit more than they are, when we see supply chains becoming a bit more efficient.
Dan McLaren, president of Commonwealth Financial, says that while everyone would like lower interest rates, the hitch is that if interest rates get too low, it can trigger inflation, thereby rising costs again.
If interest rates were to go back to where we expect them to, a year from now around 4%, the year following that around 2%, inflation rate that is, not interest, interest rates will follow and we'll have low rates again. But if you make rates too low too quick, you will trigger inflation. And there's nothing worse to an economy than high inflation. If you're a senior living on a fixed budget, as a senior, when that head of lettuce goes to $6.49, that affects how you live.
As interest rates changed, so did the market. And in our next story, we see how the market fluctuated from a buyer's market to a seller's market, and vice versa.
When discussing real estate, the terms buyer and sellers are ones heard often, usually along the lines of the market has shifted from a buyer's market to a seller's market or vice versa. But when the pandemic first roared, the market was full of buyers.
At the time, it made perfect sense that it would pop this already what felt like a very expensive housing market, and was. In retrospect, we understand the role of interest rates, the role of very generous fiscal policy, like the CERB, and then the preference shock was also important. When people are locked in their homes and can't go outside, housing becomes a much more important thing that people are willing to spend more money on.
According to the Royal Bank of Canada, a buyer's market takes place when there's a surplus of houses on the real estate market. And because interest rates were so low, everyone wanted a piece of that market.
Once the COVID hit, and all of a sudden we had these unrealistic interest rates which dropped drastically, all of a sudden along with that the values go up. So if people can borrow a lot more money because they're paying less interest, then they've got more money, than the property is worth more.
And that trend lasted during the thick of the pandemic as interest rates stayed low. However, the market has started to change as the Bank of Canada started to raise interest rates, and now with rates as high as they've been in over a decade, once again the market has shifted.
I don't think it's a coincidence that these changes in what's happening in the housing market kind of align perfectly with changes in monetary policy. So it's like the moment they started raising rates, the moment they started really cutting rates, that the housing market takes off. Then they start raising rates, it starts plummeting. And then now we've done the pause on interest rates, and now it feels like things are changing again.
And the change is one that realtors in our region are unfamiliar with.
It's a very unique market. It's market conditions that I've never seen before, in that in many respects it has become a buyer's market, but yet we still have very low inventory.
But as the weather gets nicer, experts believe that we could see more signs on front lawns, which could strengthen a buyer's market once again.
What's going to happen is we're getting into, seems to be when I'm talking to agents around our office and around town, is that one thing I noticed is that over the last years is that the weather and winter, Christmas and January and February has something to do with when the market opens up again. But also we had this interest rates which jumped up and everybody focusing on that. But now all of a sudden the weather's warmed up, and from all reports we're getting a lot more people going out through open houses. We're going to see a lot more signs coming up, and I think the market is probably going to level out.
Jack Clark, CKPG News.
But both buyers and sellers need homes, which seems easy enough. But housing demands is something that the province of British Columbia has been struggling with, to say the least. However, major swings from the provincial government is looking to change that. Jack Clark explains the recent announcement and how it could impact Prince George and our area.
In early April, the provincial government announced a multi-billion-dollar plan to construct more homes as quickly as possible in an attempt to build its way out of the housing crisis. An announcement that was much needed according to local realtors who say the housing inventory in our region is low.
And I think there are more and more people moving to the north for these different job opportunities. But they have to live somewhere. And, I think a lot of people have experienced really high rents. The lack of inventory has led to, bidding wars and, challenges for buyers finding properties.
The quote, Homes for People plan starts with a $4 billion investment over 3 years and commits to $12 billion over a decade. The latest proposal focuses on building more townhouses, duplex, and triplexes.
And I think there is a lot of opportunity to have further infill to increase the population density in Prince George. So there is opportunity for that. And that makes things more affordable in this large city where we have services spread out across a large area.
While unclear how the money will be spread out throughout municipalities, Prince George does have room to grow.
Well, when you look at for our infrastructure size, Prince George is what? We got 80 to 85,000 people in the size of a city which is the same size as Chicago. And that's what, 8 million people? So, we got room. We need more infrastructure so that we don't have such high taxes. We need more people in here, we need more concentration.
And more concentration is exactly what Mayor Simon Yu was hoping to do. The mayor made it clear during his campaign and since being elected into office that he believes the population of Prince George has opportunity to grow, and growth is something that will only help the real estate market in the community.
Hearing more and more tales of possible industry that's going to develop in the north and natural resources, and that's where it's going to be the people in. If you drive around Prince George, there are lots that are available for development. There are apartments, strata as well as rental apartments that are going up all over the place. Some of the engineers telling me that they haven't seen this much development in Prince George in 30 years.
Reducing homelessness is also a major part of the provincial government's announcement, with the proposal looking to add 3,900 new supportive housing units and 240 complex care spaces throughout the province. Jack Clark, CKPG News.
When we return on real estate in Prince George, affordability in an overpriced province, a CKPG News special, we look at where real estate could be headed in the future. Welcome back to a CKPG News exclusive special about real estate in Prince George, affordability in an overpriced province. We turn to housing projections now. For many years, those in the real estate sector have been using projections to help guide potential buyers and homeowners on what the market is going to look like going forward. But recently, with a transitioning market post-pandemic, projections may not be what potential buyers and sellers want to see. The BC Real Estate Association released its first quarter housing forecast back in February, which stated that residential sales in BC are forecast to decline 7.1% to 75,150 units this year. However, going forward into next year, the BC REA says MLS residential sales are forecast to post a strong rebound, rising 23.8%. Mark McVeigh with Team Powerhouse Realty says that with a transitioning market, it has created something he has not seen in 25 years.
It's a very unique market. It's market conditions that I've never seen before, in that in many respects it has become a buyer's market, but yet we still have very low inventory. So that's not usually what happens. Usually when buyer activity starts to wane, you start to see a surplus of listings on the market for sale. So that it creates that imbalance. But right now there's still low inventory levels, and that's creating a very unique situation in our market that I haven't seen in the last 25 years.
In the BC REA's projections, they say that inventories have increased from 2022 but remain low when compared to past years. McVeigh expects that there's going to be less housing on the market in the next few years.
So there's going to be less housing coming on the market in the next few years, which is going to lead to inventory shortages in the future as well. And of course that puts further pressure on prices, rents, etc.
With levels of inventory lower than normal, Mark says that it is hard to project what buyer demand will look like going forward.
So we are starting to see some more inventory. We will soon see if this balances out with buyer demand. I think there are buyers who want to buy, but they're waiting for properties to come on the market. So I think, there will be some more buyers that will come out of the woodwork when you see some of that spring inventory come on.
MLS average prices are projected to remain relatively flat this year, and according to the BC REA, this will likely result in negative annual price growth, even if monthly prices to begin to recover as expected later this year.
In some respects, value for money, real estate is still quite affordable. And if I had a son who's 25 years old and hadn't purchased a house yet, I would be trying to convince him to get in, have a couple of buddies rent the basement off them, just to get a foothold in the market and start developing some equity. Because I think they are going to see, because of the low inventory, quite an appreciation in equity in the next 5 to 10 years.
In northern BC, between February 2023 and February 2024, the average MLS price is projected to increase 2.4%, from $410,000 to $420,000, and unit sales are projected to increase 20%, but that will all depend on the amount of inventory available and buyer demand. When we return to this CKPG News Real Estate Special, we take a look into how many people are investing in real estate around the community and how that could impact the market right here in Prince George. Stay with us. Welcome back to CKPG TV and an exclusive special, Real Estate in Prince George, Affordability in an Overpriced Province. Thanks for staying with us. Looking at housing and real estate as an investment now. When we think of investments, we think of RRSPs, TFSAs, and others. But housing has always been seen as an investment by homeowners, landlords, and others. And if you're in it for the long term, real estate can be a very lucrative investment. Housing has always been seen as an investment, whether you choose to buy a rental property or whether it's just your own home. For many, the ultimate dream and the ultimate investment is owning your own home. But unlike other traditional investments, housing is a bit different.
Housing's a little bit different because you got to stay somewhere. And the question is, if you're going to stay somewhere temporarily, if you've got a temporary employment opportunity, then maybe 6 months rental makes a whole lot of sense. If you go on a family vacation to Hawaii for 2 weeks, you're not going to buy the hotel, you're going to rent a room. But generally speaking, the cornerstone of the so-called Canadian dream has always been based on a family owning their own home. Ownership is what has changed our economy over the last 200 or 300 years, from one of being a nation of renters to a nation of owners, which converts into a nation of investors.
While buying a home is more expensive, it may pay off in the long run.
Because after 25 or 30 years, when you own your house, your rent payments come to an end. So it's a bit more expensive to get into a house to begin with. You got to save a down payment. You got to go buy a lawnmower. You got to pay taxes. But there's nobody who sits there late in life and looks back and says, gosh, I wish I rented.
Dan McLaren, president of Commonwealth Financial, says that owning a home is a good way to generate wealth, but there is a hitch.
And our government policy in Canada, we support principal residents, because if they bought that house at $100,000 and sold it for $1 million and they made a $900,000 profit, we don't tax a nickel of that. And it's one of the few things in Canada, the very, very few things in Canada that we don't tax. So buying a house is a very efficient way to generate some wealth, assuming the market goes up. If you get into a market, say 2 years ago in the Lower Mainland, when prices were really high and then interest rates went up, you're probably underwater today, because the Lower Mainland was overpriced. There was prices for houses that just didn't bear what they were really worth. It was a bit of euphoria.
When it comes to deciding to whether invest in housing, Dan has a few suggestions.
Get yourself a down payment, struggle through the peaks and valleys of interest rates, and you'll be way better in the long run. The people who flip, if you bought a house in New Westminster 2 years ago on the idea that you're going to double your money, you're regretting that decision today. So you got to think long term. Housing is great. Short term, then you might want to look at a different investment that's fully liquid, that you don't even have to hire a realtor to sell.
When we return on real estate in Prince George, affordability in an overpriced province, we take a deeper look into the rental market and how the pandemic shifted demands throughout the province of British Columbia. Welcome back to the CKPG TV exclusive. As we get closer to wrapping up our special today, we finish the show with a deeper look into the rental market in Prince George and the surrounding area and how demands have changed for those looking and how supply and demand is leading to higher rents throughout the area.
It gets right down to it. It's a basic economic phenomena, and that's that there is too much demand and not enough supply.
Over the course of the pandemic, Canada saw massive growth in population with more than 1.5 million new people in Canada since 2019, which leaves less units to be rented.
Governments, the federal, provincial, and local level are going to have to get together to figure this out to be able to provide more housing for the huge demand that's out there.
But for those lucky enough to find a place to rent, it's not cheap. The average rent cost in the province as of March 2023 is $2,249, which is good for the most expensive average in the country, and one rental expert says he knows why.
Costs of living are high for people who are building the apartments, and the landlords, just as they are for the renters. So, everything is going up: groceries and gas and housing. All your typical expenses are up. So that plays into it. Definitely.
Now, the cost here in Prince George does look better than the provincial average, with the median rent being $1,100. But once again, supply and demand has become a serious issue throughout the region.
Every city you go to, there's a little bit different situation. I know in Prince George, you can probably find a pretty nice place to live for a one bedroom around $1,100, maybe a two bedroom around $1,400. And you can find cheap places, but they're not going to be all that nice to live in. And there's a few luxury places too, but still it's that supply and demand.
And while rent looks cheaper on paper in Prince George, Paul says it's all about perspective.
I think British Columbia is a special case because you got Metro Vancouver where rents are like ridiculously high. Then you go up to Northern BC with Prince George and they look lower, but the cost of living is a little bit different there. So it's a different situation. And when you drive 9 hours north and you end up in a place where you see the housing average cost of a house is about $290,000 versus 1.1 million, it looks pretty attractive. But for the people who are living in Prince George, 290,000 is an increase. So, the cost of housing is up in Prince George too, just as it is in Metro Vancouver.
Jack Clark, CKPG News.
And that wraps up our show today. Thank you so much for joining us on CKPG TV for Real Estate in Prince George, affordability in an overpriced market. You can catch the CKPG News every weekday at noon, 3, 5, 6, and 11. You can also like us on Facebook and follow us on Twitter. And you can catch all your local news, sports, and weather updates on ckpgtoday.ca. Once again, thank you for joining us and have a good day.